Welcome to Livewire Markets. I'm Hansley, and joining me today is Alex Hone, the managing partner at Keyview Financial Group. Today we are discussing all things private credit, and in particular, focusing on the Keyview Credit Opportunities Fund. Alex, thanks for joining us.
Thanks for having me.
So there are several private credit funds in the market, but what makes Keyview, and I guess specifically the Keyview Credit Opportunities Fund, unique in its space?
Well, one of the things we've done over the last decade or so as a team is really carve out a niche in what we call special situation opportunities. So private credit's a really attractive investment opportunity generally because you're senior secured, which we'll talk about a little bit later, which means that you're most protected in terms of style of return. And so as an investment, it typically gives you a large amount of predictability. Where we differentiate ourselves a bit and where the fund benefits materially or investors benefit materially from our skill set is finding borrowers who have a special situation that doesn't sit inside the normal element of what a commercial bank or a standard non-bank lender would be able to service. So they might have an array of complexity about their asset base or their business. There might be some structural complexity that requires unique skill sets, or there just might be a timing issue, meaning because of an opportunity or because of a circumstance, they need the money very, very quickly. And that might be a matter of weeks, which doesn't sound to some fast, but actually to go through full due diligence and establish a security package, it's very, very quick. And for that, our investors earn a very large premium over standard traditional non-bank lending or bank lending. That's the first point. The second point is the mandate gives us a huge amount of flexibility across sectors and geographies. And why that's helpful is having flexibility at times gives you more opportunity to exploit market opportunities. So at the end of the day, we would not, or no one predicted COVID, but having the flexibility of the mandate to deal with certain sectors or asset classes during that, rather than being constrained just to one sector or asset class, gave us the ability to exploit a lot more opportunities. And the final point I'd make, which is very, very important for us, is alignment. So we work very hard in everything we do to be completely aligned with our clients. All the team and the directors have a material amount of personal capital invested into the fund along with our clients. But more so, and this is often not known or understood, the majority of private credit groups out there earn additional fees or take additional fees that aren't disclosed to clients from the underlying loans. They say, no, we don't take additional fees at the fund level, which is true, but they take them at the underlying loan level. Okay, establishment fees or other elements, whereas we quite openly and transparently ensure that all the fees or all the economics of an underlying loan flow through to the fund and to investors because we find that level of alignment very important. They're three things.
Sure, yeah, absolutely. So how would you broadly evaluate the opportunity set in Australian and New Zealand private credit today?
It continues to be very, very attractive. I mean, if we put it in context, we operate in a $3 trillion marketplace. The commercial banks, including the large four, they control about 90% of that market share, with the residual 10 being for non-bank lenders. Okay, so that's about a $300 billion marketplace. We have only capacity to, in this style of strategy, to manage, we think, about a couple of $2 billion. That might grow gradually over time as the market grows or the team grows. But that's, to give you an idea, it's very, very small in a $3 trillion marketplace. So it means there's always a ream of opportunities there, given the size of the market. It's point one. The second thing I'd say is that the competition we face is quite low because of the unique skills and characteristics of the team. The entire team come in institutional background, and typically the institutions where the team come from are focusing on these style of investments, but individual investment sizes north of $150 million per individual loan. Whereas we're focused on what we call the middle market, which is that sort of sub $100 million space. And there's the same amount of work involved in a $250 million loan as there is a $50 million loan, but we don't have the same overheads and cost base. So we can have an efficiency in doing those for our investors, and we just don't find there's the same level of competition, which again means the attractiveness of the opportunity for our investors remains high.
Yeah, absolutely. So from a macro standpoint, there is just one rate cut priced into the Australian res curve this year as of when we're taping this. But we are now witnessing an economic growth slowdown in addition to that. How do these conditions impact your investment process?
We twofold. I mean, we love economic volatility. If you're there solving complexity for your counterparties, the more volatility and the more disruption in the market, the more opportunity there is for us to help and to provide capital in a meaningful way, and for our investors to benefit from that. But the second point is our portfolio, and there's a slide that should show up now in terms of our portfolio performance. It's relatively agnostic to interest rate moves, okay? Because we are lending to counterparties to solve a structural issue for them for a period of time, we're largely agnostic to what the current interest rate environment is doing. Ultimately, what we're looking at is ensuring that we have an incredibly robust and strong security package so that we have a high degree of confidence in capital preservation. And after that, because of the uniqueness of the circumstance, we're trying to price that as high a point as possible. It's unlike a bank or whatever where it's a standardized commodity product saying, hey, it's just a standard home loan. If I look at NAB, I look at CBA, or if I look at a whole array of non-bank lenders, they're all going to be the same, plus or minus a few basis points. We're not dealing in that sort of commoditized lending market as they are, so we're less susceptible to interest rate moves.
So you already alluded to this earlier, and I thought we should ask it, since you are probably the best person to ask about it. Your fund's primary focus is on senior secured credit. So what does that mean in layperson's terms?
So at the end of the day, we are lending counterparties money, and to be senior secured, or the other word that people might be familiar with is you have the first mortgage. Ultimately, we have the most security against the asset. So if you think about a house, at the end of the day, when you go and buy a house, if you get a loan from a bank, the bank is the one who actually holds the title of the house. So you technically own it, but if you get into stress or the like, they have the right to sell that to recoup their loan. And so they have those rights because they are the senior lender, they are secured against your house. And that's very, very similar to what we do. It's almost exactly similar in terms of we take a first ranking mortgage or security over a variety of assets, including the company if they generate cash, and that gives us a huge amount of protection. The other thing about it is, and I alluded to this with the bank example, it gives you a whole array of rights as well. Typically you're the last money to go in, the first money to come out, you've got the greatest amount of protection, but in addition to that, if there's a problem, you have the right to go in and actually start solving that. You don't need to rely on other counterparties or management to be doing something. You have the rights to actually be stepping in and protecting your position, and that gives you a huge amount more security in a downside scenario.
You also mentioned that your fund is sector agnostic, but I'm curious, where are you finding the most opportunities from a sector standpoint right now?
Typically when we're investing, it's a good feel for what's going on in the market environment. And I alluded to COVID before. At the start of 2020, if we were sitting here, we wouldn't have sat there, we wouldn't have said, look, we're expecting leisure and hospitality assets to become incredibly attractive this year. But ultimately you throw in a global pandemic and you have a variety of commercial banks who all step back and say, oh, we're not allowed to deal in this environment anymore. And it becomes a huge opportunity set for special situations, well capitalised, highly attractive assets that are suddenly stuck because major banks won't be dealing with them because they're constrained, and that gives us the ability to go in and solve. So in saying that, we don't necessarily forecast, but the one recent indication I'll give you is we have been a beneficiary recently, about 2 years ago on the east coast of Australia, the really large disruption to the construction building markets. What we have found in recent months is there's a large number of players, developers in that space who continue to be, progressing their developments well, but the time delays and the cost delays that were incurred 2 years ago are catching up with them now, and they needed small bridge loans to actually finalise projects, etc. And for that, we could then capitalise a whole variety of other assets that they had, and the risk return on those are incredibly low. We're talking 50% loan to value ratios with 20% IRRs because of the short-term structural nature of what we had to go through with them.
Got it. So the fund targets an 8 to 10% per annum return over rolling three-year periods, but I'm curious, how do you balance this goal against the need to also preserve capital and protect against the downside?
Capital preservation's our first and foremost requirement, and so it's not a hard thing to balance at all, because we have a risk framework in terms of what that looks like and when we're comfortable with the level of risk we're taking with our client capital, and we continue to be able to deploy that very, very successfully as we've done over a long period of time. But the second point is we find that there is always opportunities that come along. I talked about the size of the market. That we're less than 1% of the market. We're closer to 10 basis points in terms of total market size of the capital we want to deploy, and it just means that if there's not an opportunity today, you just need to be patient. You don't ever want to change your parameters or your focus on the sort of capital you're allocating, and opportunities come along, and we've been able to achieve above those rates of return for a very, very long period of time for our investors.
So let's put this all together then. If people do want to get involved, what is the minimum investment for this fund and how do you generate your returns?
So the minimum investment is for wholesale-only clients, and it's $250,000. But the returns of the portfolio, which we aim to provide consistently and consistent with our track record, is the combination of all those loans. So we generally have above 25 loans in the portfolio at any point in time, and the returns that investors generate are a function of all those loans continuing to pay their interest rate and then their capital return, and the portfolio continues to reallocate to new loans. How that then manifests itself for investors is via a quarterly distribution, which is at the moment set at 2.5%, with the residual amount being paid at the end of the financial year. So if the portfolio does a return of say 11%, that final return would be 3.5%, 2.5%, 2.5%, 2.5% each quarter, and then the final quarter being 3.5%, making up the total return of 11%. So it's a relatively liquid strategy for investors, but the consistency of return is really what we're focusing on.
All right, Alex Hone, thank you very much for joining us.
Pleasure.
And thank you for joining us. If you enjoyed that conversation, please subscribe to the Livewire and Market Index websites, as well as our YouTube channel. We thank you for watching.